So this is accounting. This is not just accounting, this is finance, right? There's an amazing amount of information for every business transaction. And what makes us valuable is that we can disseminate that information and analyze it in ways other people can't. And that's what I'm trying to teach you here, is we can take the same fact set and look at it. We're looking at it 4 different ways. But if you further your education in finance and accounting, there's actually 20 plus ways you can look at this. And so based on the way we look at it, we can interpret it differently and have different insights, which make us valuable compared to people who can't do this, right? That's why I'm trying to teach you these skills. I know it might seem like a little dense, a little heavy, because we're just looking at the same numbers and recalculating them, but try to get beyond that and realize the interesting part is we can look at the same fact set differently. And so I have another question about, wouldn't most firms want to avoid taxes? Not necessarily. Most firms don't want to minimize their tax, because reporting positive income is a good thing. Like higher margins is a good thing too, to get investors involved, right? Also, in theory, accountants shouldn't choose a way just for a tax avoidance strategy. They should choose a methodology that most accurately reflects their accounting or the substance of the transactions. Our job as accountants isn't to manipulate information, it's to accurately depict what's happening. So let's go. But also your job as an accountant now is no one can BS you. If you looking at a company, you're like, wow, they have a really good gross margin, but maybe they should be using a LIFO method. Now you can interpret the information and not get swindled, right? So actually, the weighted average. When a unit is sold, the average cost of each unit of the inventory is assigned for cost of goods sold. So weighted average, we would do this kind of method. So we have the 910, the 15 at 106 is 1590. And so here, 20, let's see how I want to make sure that they're doing this one right. The same example. Let's see. Right, we're doing the same 20 at 100. Try to give me 1 second after the sale. Goods purchased. We're starting at the 14th. Okay. And so we're saying at this 14th amount, I'll put the weighted average here. We know this plus this is 25. This total cost here, 2,500. Weighted average. So our weighted average is here, our $100 per unit. And then so our weighted average cost, I'll put here too. We'll make a weighted average section here, weighted average. Copy paste this. Again, weighted average is just like LIFO, where we can't take we can't just look at the ending balance. We have to look at it from a rolling transaction basis. And we're assigning 20 units of cost based on the weighted average at this selling point. And then we'll do it again here. So we know that units sold are 20 here. We're going to calculate on this sale how much is left. So we know 20 minus 25 minus 20. What we'll do here. Let's see. 25 minus 20. Plus 20 plus 10. We have 35 units left. We know how we had the remaining cost of cost of goods available for sale. So we know we had 2,500 minus this, 2,000 plus this is our 3,990. And so our weighted average cost per unit is going to be 114. And then we would determine, based on how much were sold, the cost assigned. So 2,622. And that gives us a total cost somewhere of 4,622. Notice how that's different than LIFO, how it's different than FIFO of 4,570, how it's different than specific identification of 4,582. Okay, every one gives you a different answer. And so to slow that one down, right, the difficulty with the weighted average method is you need to recalculate that weighted average every time you make a sale. And so what we did here was we took out 20 units from this 25 to figure out our 35. So I subtracted the 20 and then added the new purchases. And then for the total costs, I had to subtract out what was already allocated. So we already allocated 2,000 to the original inventory. And so we had 500 left. And then we had to add in the new costs. So that's how we get the weighted average. So here's all our answers, the 4,622, 470. And I'll make a summary here. So we can see from specific identification, I'll call it SI, FIFO, LIFO, and weighted average answers, we can see all the differences. That's our, and these would be our cost of goods sold. Note that this would also change our inventory balances as well, right? LIFO. So based off of this information, we can have a range that varies about $160. Now, this might not seem like a lot to you, but now imagine if these numbers are in millions, right? Which is very likely for large businesses. So just by choosing an inventory method, a company could theoretically change the amounts of costs it recognizes in its inventory by hundreds of millions of dollars. So we can see the importance of understanding why we have these methodologies and understanding the usefulness of it so we can interpret information, and then B, the application of it, right? Make the decision of what do we want to choose. $160 million times a 40% tax rate. Like, theoretically, if you accidentally chose the wrong method, you could have maybe had an additional $64 million tax bill, right? So that's where an accountant can be valuable. So that's the weighted average method.